Hello and welcome to Explain the Charts. Today, September 11th, 2025, we are diving deep into USDJPY, analyzing both the latest news and its impact on the charts. The currency pair is currently at a crucial juncture, heavily influenced by upcoming economic data and ongoing geopolitical shifts. Let's start by looking at the broader market sentiment and the key headlines driving USDJPY today. The Japanese yen is showing significant weakness, hitting a three-day low against a broadly firmer US dollar. This is primarily attributed to political uncertainty in Japan following Prime Minister Shigeru Ishiba's resignation, which may delay any monetary policy normalization by the Bank of Japan. A generally positive risk tone in the broader markets is also undermining the safe haven appeal of the JPY. Meanwhile, the US dollar has seen varied movements. While initially slightly stronger, it slipped ahead of the crucial Fed decision. However, geopolitical tensions such as reports of Russian drones in Polish airspace have also fueled some safe haven demand for the dollar, pushing the DXY towards 98.00. A major catalyst for today is the US Consumer Price Index, or CPI report, which is expected to provide further direction. Yesterday's benign producer price release already fueled expectations for more aggressive Federal Reserve policy easing, with markets now pricing in almost 3 Fed rate cuts by year-end. Some analysts even see a slight possibility of a 50 basis point cut at the September 16, 17 meeting if today's CPI comes in soft. Conversely, Japanese economic indicators like the Producer Price Index and revised Q2 GDP suggest a potential BOJ rate hike by year-end, which should theoretically support the yen. However, the political uncertainty in Japan is creating market hesitation, making traders reluctant to fully price in aggressive BOJ tightening. Now, let's turn our attention to the charts, starting with the one-day time frame to understand the broader context. Looking at the daily chart, we can see USDJPY has experienced a significant downtrend from its highs in April 2024, when it touched around 160.185. The pair then saw a sharp decline through May, June, and especially July 2024. This period saw a multi-week drop, with prices moving from around 153.9 on July 24 to hitting lows near 141.6 in early August 2024. This substantial move aligns with the news of a poor jobs report for August and increasing Fed rate cut expectations, indicating a strong fundamental correlation. Such sharp declines often mark a shift in market sentiment, moving from dollar strength to yen recovery due to dovish Fed outlooks. After stabilizing in August 2024, the pair entered a choppy recovery phase. Zooming into the more recent daily action, focusing from August 2025, we observe that the pair has been range-bound. On September 2nd, we saw a notable bullish candle, pushing the price from around 147.1 to 148.58, but this was quickly met with selling pressure. The subsequent candles have shown retracement and indecision. Currently, USDJPY is hovering around 147.3 to 147.4, indicating it's struggling to maintain any upward momentum. Key resistance levels to watch on this daily chart are near 147.75 to 147.80 and the crucial 148.00 psychological mark. A sustained break above 148.00 could open the path towards the 200-day simple moving average, around 148.75. and then 149.00 to 149.15. On the downside, initial support lies around 147.00, with stronger support at 146.30 to 146.20, and then 145.00. A failure to hold the 146.20 level would likely signal a stronger bearish shift. Now, let's switch to the 1-hour chart, which provides a more granular view of recent market behavior, although our available data for this time frame ends in late August 2025. Even in this slightly older data, we can identify a significant drop on August 22nd, where the price plummeted from around 148.59 to 146.84 within a single hour. This highlights how quickly sentiment can shift and the pair can react to news, even if it's not the most current data point. This kind of sharp move demonstrates the volatility inherent in forex trading and the importance of monitoring economic releases. The current news suggests USDJPY is stuck in the range ahead of the US CPI report. This implies that recent price action on the hourly chart would likely show consolidation and lower volatility, reflecting the market's anticipation. For the most current short-term picture, we need to examine the 15-minute chart, covering action right up to September 10, 23:47 Universal Time Coordinated. Here, we can clearly see the range-bound activity discussed in the news. The pair has been trading in a very tight band, predominantly between 147.3 and 147.4. This tight consolidation is a classic sign of market participants awaiting a significant catalyst, in this case, the US CPI report. The low volume observed in some of these recent 15-minute candles further reinforces the cautious sentiment. Traders are essentially holding their breath, waiting for a definitive signal to break out of this narrow range. A break above 147.45 could see it retest 147.50 to 147.55, while a drop below 147.3 could quickly challenge 147.25 to 147.20. The range on the 1-hour chart mentioned in the news, between 146.60 and 148.50, provides a larger context for these smaller fluctuations. Short-term traders can capitalize on these mini-ranges by buying at the lower bounds and selling at the upper bounds, but with very tight stop-losses given the imminent news. In recap, USDJPY remains influenced by the dovish Federal Reserve expectations versus potential, but politically delayed, hawkish shifts from the Bank of Japan. The key price levels to watch are immediate support at 147.00 and further down at 146.50 and 146.20. On the upside, resistance is strong around 147.75 to 147.80, with a more significant barrier at 148.00 and then 148.50. A breakthrough above 149.00 would signal a shift to a stronger dollar bias. Our unbiased prediction is that the US CPI report will be the primary determinant for the next major move. If CPI comes in softer than expected, the likelihood of more aggressive Fed rate cuts increases to about 60 to 70%, reinforcing bearish pressure on USDJPY towards 146.20 or even 145.00. Conversely, if CPI is hotter than expected, indicating sticky inflation, this could pare back Fed easing expectations, pushing USDJPY to retest 148.00 or higher with a 50 to 60% probability. Look for increased volume accompanying any breakout from the current tight 15-minute range as a confirmation signal. The University of Michigan Consumer Sentiment Report tomorrow will also be an important follow-up catalyst. For long-term traders, the underlying divergence in monetary policy between the Fed and BOJ continues to be the dominant theme, making any sustained break above 149.15 or below 145.00 significant. Always remember to manage your risk, utilize stop losses, and consider the broader macroeconomic picture.